Hello viewers, welcome back to the series Bhaskar's Insurance for You and Me. Like in our last episode, we will deal with few more frequently asked questions on motor insurance in this episode also. First we'll look at the question, what are the different components of premium under motor policies and what is the basis for their computation? The premium under a comprehensive or package policy has three components. The own damage premium, known as OD premium, liability premium, personal accident premium. If the insured has not opted for OD cover, like in case of liability only policies, no premium is charged under OD section. We shall now see the various elements that go into the working of these premium amounts. In respect of own damage premium, it is calculated by insurers based on many parameters relating to the vehicle and the area of operation of the vehicle. The important parameters are like vehicle type, whether it's a private car, two-wheeler or commercial vehicle, CC or the engine capacity of the vehicle, age of the vehicle, area in which the vehicle is registered. Based on these details, the insurer would decide on the premium rate applicable, which is applied on the IDV of the vehicle. On this amount, different discounts are also allowed. There are many additional or extra benefits provided under the motor policy like nil depreciation cover. If the insured has opted for such add-on benefits, the premium arrived at as above is loaded for these add-on covers. The sum total of all these steps result in the overall OD premium for the policy. Now we will see what are the different discounts allowed in the OD premium. The first one is a no claim bonus. It is a discount given by the insurance companies to insureds when there are no claims made under the policy. It is a reward for safe driving and responsible ownership of the vehicle. And this was already discussed in detail in our last episode. The second one is known as voluntary deductible discount. The motor policies are subject to compulsory deductibles, otherwise known as policy excess. This is the amount of claim which the insured must necessarily bear on his own out of each and every claim under the policy. The insurer is liable to pay only the balance. For example, a private car policy with a capacity of less than 1500 cc is subject to a compulsory deductible of rupees 1000 for each and every claim. If there is any claim under the policy assessed for, let us say, rupees 10,000, the compulsory deductible amount of rupees 1000 is deducted and only rupees 9000 would be payable. Besides this compulsory deductible, there is a provision for the insured to opt for additional deductible amount, what is referred as voluntary deductible. This refers to the additional amount which the insured is agreeing to bear from the claim amount before the insurer steps in to pay the balance claim. So if the insured opts for such voluntary deductible, the insurer allows some additional discounts in the OD premium, which is referred as voluntary deductible discount. This is actually a mechanism for the insured to reduce the premium outgo, at the same time agreeing for bearing a higher claim amount as deductible from his own pocket. The next one is discount for risk minimization. If there are any risk mitigating factors like anti-theft device installed or in membership of automobile associations, etc., the insureds are allowed some additional discount on the premium. The other kind of discount is what is known as underwriting discount. These are additional discounts based on the overall experience under the policy, which is provided on case-to-case basis and referred as D-tariff discount or underwriting discount or experience-based discount. Though factors like driver's age, fuel type, insured's occupation, etc. have certain influence on the loss frequency, these are not explicitly considered as rating factors by the insurers to arrive at applicable premium rate. However, these factors are considered while deciding on the underwriting discounts, thereby impacting the final OD premium. So the next component of the premium is the TP premium. The premium rates applicable for third-party liability cover is fixed by central government in consultation with the IRDAI and it is notified through gazettes. So these rates are periodically reviewed and the revised rates are gazetted. The premium rates are provided for different categories of vehicles. Some of the categories are like vehicle type. The different rates are given for different vehicle types like private cars, two-wheelers, goods carrying commercial vehicles, goods carrying motorized three-wheelers, trailers, special types of vehicles, etc. And the second aspect is the vehicle capacity. Within each vehicle type category, the vehicles are further categorized based on their engine capacity, that is CC, or gross vehicle weight, that is GVW, the number of passengers carried, etc. And there are separate rates provided for electrical vehicles. In respect to the vehicles which are permitted and used for carrying passengers, there is additional premium rates chargeable per passenger basis, which is fixed and specified in the Gazette itself. And the premium rates are also provided for long-term policies. So the premium rates published in the Gazette, they are the standard rates which must be charged by insurers without any deviation. Besides the base TP liability premium, as we discussed, this section also includes the additional premium chargeable for various additional liability covers like legal liability to paid drivers or employees in connection with the running of the motor vehicle, or legal liability to employees of the insured traveling in the employer's vehicle other than say paid driver, cleaner, conductor, etc. The third component of premium is the personal accident premium. It is a premium charged towards compulsory personal accident cover for owner driver and also the other optional PA covers. So this particular aspect of the coverage was discussed in detail in our earlier episode. So you can refer to that. So these three components together constitute the premium for the policy. And on this amount, the GST as per the existing rates are chargeable. So now the next question which we will discuss is, what is the meaning of add-on covers under motor insurance policy? The standard motor insurance policy provides certain standard covers which we have been discussing over many episodes so far. The insurers provide certain additional features either to enhance protection or for providing additional services under the policy, which are referred as add-on covers. These are actually the optional benefits which a vehicle owner can purchase by paying additional premium. The add-on cover available and the scope of the covers varies from insurer to insurer. Also, these covers are subject to a set of specific conditions. Hence, the insureds are advised to go through the wordings of these clauses to understand the scope and suitability of the cover provided under different add-on covers and opt for them. In order to appreciate the nature of these add-ons, I am giving few examples of the add-on covers with the brief coverages. The first one is a nil depreciation cover or zero dip cover or depreciation shield. If opted for this cover, the partial loss claims are settled without deducting the depreciation. Similarly, you have key replacement cover. It pays for the cost incurred towards repair or replacement of the keys and our new lock set and a total replacement of lock mechanism due to theft or burglary or damage to keys and key mechanism of the insured vehicle, including installation cost. Similarly, you have an add-on cover known as NCB protection, which protects the NCB, that is no claim bonus, being enjoyed by the insured and allows NCB at the time of renewal either fully or partially, even when there is a claim reported for the insured vehicle under the policy. Whether the NCB is retained fully or partially depends on insurer to insurer, it varies. Similarly, I have consumable cover, which provides cover for reimbursing the cost of consumable items like nuts, bolts, screws, bearings, washers, clips, etc., subject to there being a own damage claim at the same time. You have tire protection cover, which provides for reimbursing the cost of replacement of the tire fitted to the insured vehicle if it is damaged due to bursting, cutting, or bulge, including the labor cost. The PA cover or accident shield. It provides death and permanent disablement covers to the occupants or passengers. This, of course, we have already discussed in the earlier video also. You also have something known as engine protector or hydrostatic lock cover. It provides cover for reimbursing the cost of repair or replacement of parts of engine or gearbox due to ingress of water into the vehicle or due to leakage of lubrication oil. And there are add-on covers relating to the value-add services, otherwise known as roadside assistance or spot assistance. Here, the insurer provides various roadside assistance to the insured, like battery jumpstart service, flat tire replacement service, fuel delivery, emptying of fuel tank, etc. in case of the immobilization of the insured vehicle. You have an add-on which is known as return to invoice, where in case of the insured vehicle being damaged as total loss or constructive total loss, the insured will be paid the sum insured under this add-on cover. The sum insured under the add-on cover being the difference amount between the IDV under the policy and the total actual expenses incurred towards acquisition of a new vehicle of similar make and model. You also have an add-on cover known as EMI Protect, which provides for payment of EMI in case there is a loan availed against insured vehicle and the vehicle is not available for use due to accidental damage to the vehicle and the vehicle is lying in garage beyond a certain number of days. So as the number of add-ons are too many and it varies from insurer to insurer and the terms of the add-on cover also varies from insurer to insurer, I'm not listing out all of them here, only a sample is provided. In case the viewer wants to understand about the other add-ons, it is suggested to visit the download section of the websites of insurers and go through the relevant wordings. The next question we are discussing is what is meant by usage-based insurances. In motor insurance policies, traditionally the own damage premium is calculated by insurers based on many parameters relating to the vehicle and the area of operation, as we have already seen earlier. However, there are several other aspects of the use of the vehicle. For instance, customers who use their vehicles for lesser duration or lesser distances, they are prone to lesser risks. And those who use their vehicles for longer duration and more distances are prone to more risks. Similarly, the driving behavior, like how one accelerates or how one brakes, what is the speed of driving, etc., also have impact on the risk. So in order to consider these aspects also into pricing of motor insurance products, IRDA has allowed introduction of motor insurance products on the basis of pay as you drive and pay how you drive. So the insurance products based on these models are referred as usage-based insurances. Now many of the insurers have add-on covers based on the usage, where the premium for own damage section is linked to the usage. As of now, these add-on covers are available for private car and two-wheeler types of vehicles only. Now we will see the different models available under usage-based insurance. The first one is pay as you use. So in pay as you use model, the premium is discounted based on the kilometers the vehicle is estimated to be clocked during the policy period. The insured is provided an option to choose the kilometer range the vehicle is estimated to be driven during the policy period, based on which a discount is provided in the premium. Insured is also allowed to top up or recharge additional kilometers on payment of additional premium once the initially opted kilometers are exhausted. Alternately, some insurers offer a certain discount based on the kilometers the vehicle was driven during the year at the end of the policy period, instead of the insured providing estimated kilometer of driving in the beginning of the policy. So the next model is pay how you use or pay how you drive. In pay how you use or pay how you drive, the premium is affected by the way the insured vehicle is used or driven. The driving score is derived using different parameters obtained through use of technology, that is telematics or IoT devices, etc. And a certain discount or loading is arrived based on the driving score band and this is applied on the premium at the time of renewal. The insured is provided an option to choose pay as you use or pay how you use, or both, in which case it is referred as pay as you consume, or he can even opt out of both these covers. So opting for these covers would not impact the insured's choice to opt for other add-on covers or even the NCB eligibility. So these are some of the models, the usage-based insurance models. Before closing this episode, I would like to make one correction to my earlier episode. While discussing about nil depreciation cover, I had mentioned that the add-on nil depreciation is being offered to private cars and two-wheelers only. However, please correct the same. The nil depreciation cover is being offered under commercial vehicle policies also by many of the insurers. So in this episode, we have discussed few more FAQs on motor insurance policies. We will meet again in the next episode with few more important aspects about the motor insurance. Till then, bye from Bhaskar.